On December 10, 2025, the Federal Reserve Bank of New York issued an operational update that went largely unnoticed by mainstream financial media, but sent shockwaves through commodity trading desks. The Fed announced it would no longer have an aggregate operational limit on its standing overnight repurchase agreement facility. In plain English, the Fed just removed all caps on emergency lending to banks through the repo market. This wasn't a routine technical adjustment. This was the Federal Reserve preparing its plumbing for a major bank to need massive emergency liquidity and setting up the infrastructure in advance to handle it. Within days, that preparation proved prescient. On December 26th, while markets were closed for the holiday, the New York Fed injected $17 billion in emergency cash to an unnamed financial institution through overnight repo operations. That single-day injection matched the largest repo operation conducted outside of the March 2020 COVID panic. From early July 2020 until Halloween 2025, the Fed conducted virtually zero repo operations with Wall Street banks. Then suddenly, on October 31st, someone needed $51 billion in emergency cash. The December 26th injection brought total emergency liquidity to $85 billion within 2 months. The Fed doesn't identify recipient banks, maintaining opacity, supposedly to prevent stigma and market panic. But that opacity creates systemic risk because markets can't assess who's exposed or how concentrated the vulnerability might be. What we do know is that this emergency lending coincided precisely with the most volatile period in silver markets since 1980. Silver rallied from approximately $30 per ounce at the start of 2025 to over $85 by late December, a 183% gain in 12 months. Then it crashed 17% in 72 hours from December 29th through year-end, the most violent drawdown since the Hunt brothers' collapse. Throughout this volatility, the Chicago Mercantile Exchange raised margin requirements on silver futures twice within 48 hours, attempting to cool what regulators viewed as a dangerously overheated market. The connection between Fed emergency lending and silver market stress isn't speculative conspiracy theory. It's cause and effect visible in the timeline. Major banks maintain substantial short positions in precious metals derivatives. When silver prices rally rapidly, those short positions generate mark-to-market losses that must be collateralized through margin deposits with clearinghouses. Under normal conditions, banks manage these margin requirements through their regular funding operations. But during extreme price moves, margin calls can exceed a bank's immediately available liquidity, forcing them to access emergency funding from the Fed to meet same-day collateral demands. If they fail to post margin, the clearinghouse can liquidate their positions, potentially triggering a cascade of forced buying that drives prices even higher. This creates a feedback loop where rising silver prices generate larger margin calls, requiring more emergency funding, which signals market stress, which attracts more speculative buying, which drives prices higher, which generates even larger margin calls. The cycle continues until something breaks, or regulators intervene to stop it. The CME's margin increases were precisely such intervention. On December 27th, they raised initial margin requirements for silver futures from $22,000 to $25,000 per 5,000-ounce contract, a 13.6% increase. This forced leveraged traders to post additional collateral or liquidate positions. The selling pressure from forced liquidation triggered the subsequent crash from $85 to $71. But here's what the media didn't report and most analysts missed. That margin increase targeted long speculators who were driving prices higher. What about the short hedgers on the other side of those contracts? Those shorts faced even more acute pressure because they were underwater on positions established at much lower prices. Consider a bank that sold silver futures at $40 per ounce earlier in 2025 as part of hedging operations or proprietary trading. When silver rallied to $85, that short position was losing $45 per ounce. On a single 5,000-ounce contract, that's $225,000 in mark-to-market losses requiring collateral. Now multiply that single contract by thousands or tens of thousands of contracts across multiple banks' trading books. The aggregate collateral requirement can reach billions of dollars that must be posted immediately to avoid position liquidation. And unlike long speculators who can simply sell their positions to meet margin calls, shorts who try to cover by buying back contracts drive prices even higher, exacerbating their losses. This is why the Fed's unlimited repo facility matters. It provides a safety valve, allowing banks to access emergency funding to meet margin requirements without liquidating other assets or covering short positions at unfavorable prices. The Fed essentially backstops the bank's ability to maintain short positions, even when those positions are generating massive losses. The 10% figure in the title requires explanation. It doesn't refer to margin requirement percentages or Fed interest rates. It refers to the approximate portion of global refined silver supply that could be effectively blocked from reaching Western markets by the combination of Chinese export restrictions and the collateral demands those restrictions place on Western financial institutions. Here's how this works. China implemented export controls on January 1st, 2026 that restrict approximately 60 to 70% of globally traded refined silver to domestic use. That leaves roughly 30 to 40% of supply available to Western markets under the new licensing regime. But Western industrial users need closer to 50% of global supply to meet their manufacturing requirements. That 10% gap represents the structural shortage that must be filled through some combination of higher prices rationing demand, inventory drawdown, or new supply development. It's the delta between what's available and what's needed, and it's exactly the size of shortfall that triggers explosive price moves in commodity markets. The Fed's role in this equation is maintaining financial stability while this structural adjustment occurs. If silver prices must rise to ration demand, that's acceptable. But if prices rise so quickly that major banks face insolvency from derivatives losses, the Fed steps in with emergency liquidity to prevent cascading defaults. This creates moral hazard, where banks can maintain larger short positions than prudent because they know the Fed will provide backstop funding during market stress. That encourages more aggressive risk-taking and position sizing than would occur in a truly free market without implicit government guarantees. The standing repo facility that the Fed expanded on December 10th operates as follows. Eligible financial institutions can borrow cash from the Fed overnight by pledging Treasury securities and agency mortgage-backed securities as collateral. The Fed charges a premium rate above the federal funds rate to ensure banks use this facility only during genuine funding stress rather than routine operations. Prior to December 10th, this facility had an aggregate operational limit of $500 billion across all participating institutions. By removing that cap, the Fed signaled its willingness to provide unlimited overnight funding to the banking system. This is quantitative easing by another name, though the Fed carefully avoids using that term to prevent market panic or political backlash. The rationale provided focused on year-end funding pressures and Treasury market functioning, but the timing coinciding with extreme precious metals volatility suggests commodities exposure played a significant role in the decision. When the Fed says it's acting to ensure market functioning, that's often code for preventing major institution failures that would trigger broader systemic problems. The $17 billion December 26th injection becomes more significant when you understand how repo operations work. These are overnight loans that must be repaid the next business day. If a bank needs $17 billion on December 26th, they presumably needed similar amounts on subsequent days. The reported figures represent daily snapshots, but the actual ongoing funding requirement could be far larger when you sum across multiple days. Between late December 2025 and early January 2026, standing repo facility usage exceeded $40 billion on multiple dates. That's $40 billion per day in emergency funding to unnamed financial institutions. Over a 2-week period, cumulative lending could easily reach $200 to $300 billion, even though each individual day's snapshot shows much smaller numbers. This is how financial crises develop beneath the surface before becoming publicly visible. Institutions access emergency funding through obscure facilities that don't generate headlines. The Fed provides liquidity to prevent immediate failures, but the underlying exposures and losses don't disappear. They accumulate until eventually something triggers recognition and broader market reassessment. The Basel III capital requirements add another dimension to this situation. These international banking standards, implemented progressively since 2013, require banks to maintain minimum capital ratios based on risk-weighted assets. Derivatives positions, including commodity futures, count toward these calculations, with risk weights based on volatility and exposure size. When silver volatility spiked in late 2025, the risk weights on silver derivatives positions increased dramatically. This forced banks to either add capital to maintain required ratios or reduce position sizes. Since raising capital quickly is difficult, most banks tried to reduce positions. But with industrial demand remaining strong and Chinese supplies restricted, attempts to cover shorts drove prices higher, increasing losses and risk weights further. This creates another destabilizing feedback loop. Higher volatility increases risk weights, forcing position reduction, which increases volatility, which increases risk weights further. The cycle continues until prices reach levels where industrial demand destruction occurs, or new supplies emerge to satisfy physical delivery demands. The Fed's emergency lending doesn't solve this problem. It merely delays the day of reckoning by allowing banks to maintain positions they should be forced to liquidate under market discipline. This postpones adjustment and likely makes the eventual repricing more violent when it finally occurs. The month-end timing reference in the title relates to reporting cycles and regulatory deadlines. Banks must report their balance sheets and capital positions to regulators at month-end. This creates strong incentives to window dress positions and access temporary funding to present stronger financial conditions than actually exist day to day. If a bank faces margin calls throughout December requiring Fed repo access, they'll try to pay down that emergency borrowing before month-end reporting to avoid showing reliance on Fed support. This creates artificial demand for overnight funding right before month-end, followed by immediate payback after the reporting date passes. The pattern of Fed repo usage in late December 2025 matches exactly this window dressing behavior. Large borrowing through Christmas week, minimal usage on December 31st for year-end reporting, then immediate resumption of borrowing in early January. This suggests the banks accessing Fed support don't have genuine alternative funding sources. They're dependent on Fed facilities, but trying to hide that dependency from regulators and markets. The confirmed aspect of the title refers to publicly available data from the Fed's website showing repo facility usage. This isn't speculation or anonymous sources. It's official Federal Reserve reporting that anyone can verify. The mainstream financial media simply chose not to investigate why massive emergency lending was occurring simultaneously with precious metals volatility. The secret component refers not to the Fed's actions, but to the identity of institutions accessing support and the specific exposures requiring emergency funding. That information remains confidential, allowing banks to avoid public scrutiny and market pressure that would normally accompany financial distress. This opacity serves the Fed's goal of preventing bank runs and systemic panic, but it also enables institutions to take excessive risks knowing their problems can be hidden from public view through confidential Fed lending. It's privatized profits during good times and socialized losses during bad times, with taxpayers ultimately bearing the cost of bailouts. The silver market's role in this dynamic deserves emphasis because it's been largely ignored by mainstream analysis. Most commentary about Fed policy focuses on inflation, employment, and financial stability in abstract terms. But the actual stress points triggering Fed intervention often involve specific markets and institutions facing acute problems. In this case, silver appears to be one of those stress points. The combination of Chinese export restrictions, structural supply deficits, and industrial demand growth created conditions where physical scarcity drove prices dramatically higher. Banks with short positions faced large losses. The Fed provided emergency funding to prevent forced liquidation that would drive prices even higher. This becomes problematic when you consider the Fed's statutory mandate. They're supposed to promote maximum employment, stable prices, and moderate long-term interest rates. Providing emergency lending to banks maintaining short positions in commodity markets doesn't obviously advance any of those goals. If anything, it interferes with price signals that should ration scarce supplies and encourage new production. But the Fed also has an implicit mandate to prevent financial system collapse. If major banks failed due to commodity derivative losses, that would threaten broader economic stability through credit contraction and contagion effects. So the Fed intervenes to contain specific problems even when those interventions distort markets and create moral hazard. The 10% block represents the portion of supply that effectively gets frozen due to this intervention. Banks can maintain short positions rather than covering them. That keeps synthetic supply in the market through derivatives, even though physical supply is constrained. The paper market continues functioning with ample liquidity, while the physical market faces acute shortage. This explains why COMEX futures prices remained somewhat contained, even as physical premiums exploded in Asian markets. The Fed's backstop allowed continued paper market trading and position rolling without forced covering that would drive futures prices to match physical levels. It's price suppression through financial system support rather than direct market intervention. The strategy has limits. Emergency lending can delay forced liquidation, but can't create physical silver that doesn't exist. Industrial users demanding delivery will eventually overwhelm paper market capacity regardless of Fed support. At that point, either futures prices must rise to reflect physical scarcity, or exchanges must suspend physical settlement in favor of cash only. The CME's January 13, 2026 implementation of percentage-based margin requirements represents another form of indirect market management. Instead of fixed dollar margin amounts, the new system requires margins equal to a percentage of contract value. For gold, that's 5%. For silver, it's 9 to 11% depending on the contract. This means margin requirements automatically increase as prices rise, creating natural governors on leverage and position sizing. It's supposed to promote stability by ensuring adequate collateralization, but it also means that every price increase generates additional margin calls that require more emergency funding for banks maintaining losing positions. Under the new system, if silver rises from $75 to $150 per ounce, margin requirements double automatically, even without exchange officials actively hiking minimums. That doubling generates immediate collateral demands for all market participants. For banks with large short positions, this could mean tens of billions in additional margin requirements. The Fed's unlimited repo facility becomes critical in this context. As silver prices rise toward the levels Bank of America forecasts, 135 to 309, margin requirements under percentage-based systems will increase proportionally. Banks will need exponentially larger amounts of emergency funding to maintain positions. Without the Fed's backstop, they'd be forced to cover, potentially triggering the very price spike the Fed is trying to prevent. This creates a situation where Fed policy effectively determines how high silver prices can rise before systemic stress forces intervention or position liquidation. The limit isn't set by supply-demand fundamentals or industrial user willingness to pay. It's set by how much emergency lending the Fed will provide to banks with underwater short positions. That's financial system capture of commodity markets. Prices should be determined by genuine buyers and sellers transacting based on their actual needs and expectations. Instead, prices are influenced by Fed lending policy that enables sustained short positions regardless of fundamental conditions. The international dimension adds complexity. The Fed can backstop U.S. banks accessing dollar funding through repo operations, but it has no direct authority over foreign banks or non-dollar transactions. If silver shortage manifests primarily in Asian physical markets trading in yuan or local currencies, Fed policy has limited impact. This might explain why physical premiums in Shanghai and Tokyo have widened so dramatically, while COMEX futures remain relatively contained. The Fed can influence dollar-denominated paper markets, where U.S. banks are major participants. It cannot prevent Chinese industrial users from bidding up physical silver in yuan-denominated transactions in Shanghai. The bifurcation between dollar paper prices and physical prices in other currencies could accelerate if Fed policy increasingly diverges from physical market reality. Industrial users would route procurement through channels and currencies where real market prices prevail. Dollar paper markets would become increasingly detached, serving primarily as financial speculation venues rather than genuine commodity price discovery. This would mark a historic shift in how commodity markets function. For decades, dollar-denominated futures exchanges in New York and London set global benchmark prices that other markets referenced. If that price leadership shifts to physical markets in Asia trading in local currencies, it represents a fundamental change in global financial architecture. The Fed's actions over the past 2 months suggest officials understand something serious is occurring in commodity markets, even if public statements minimize concerns. You don't remove limits on emergency lending facilities and inject tens of billions in overnight funding unless genuine stress exists. You don't implement such measures during a period of supposed economic strength and normalized monetary policy. The silver market represents both symptom and cause of this stress. Symptom because the extreme price moves reflect underlying supply shortages and geopolitical tensions. Cause because banks' derivatives exposures generate funding stress that requires Fed intervention. These two aspects reinforce each other, creating conditions where problems can escalate rapidly. The month-end timing matters because that's when banks must show regulatory compliance and financial strength. If they're dependent on Fed emergency lending throughout the month but hide it at month-end through temporary paydowns, regulators get a false picture of true financial conditions. The system appears stable in official reports, while actual day-to-day operations require constant central bank support. This is how 2008 developed. Bear Stearns and Lehman Brothers passed regulatory stress tests and reported adequate capital right up until they collapsed. The official snapshots missed the reality of desperate daily funding needs and deteriorating asset quality. By the time problems became publicly visible, contagion and panic had already taken hold. The silver situation in early 2026 exhibits uncomfortable parallels. Banks report stable operations. Regulators express confidence. But beneath the surface, emergency Fed lending spikes to levels not seen outside of acute crisis periods. Commodity markets exhibit extreme volatility and physical paper price divergence. And geopolitical supply restrictions remove the comfortable assumption that market stress can be resolved through simple price adjustments. The 10% block confirmed for month-end represents the structural shortfall that cannot be papered over through Fed lending or margin requirement manipulation. That physical supply gap must be closed through some combination of demand destruction, new supply, or price increases sufficient to ration consumption to available metal. The Fed's actions postpone recognition of this reality. They provide breathing room for banks to manage positions and funding stress, but they don't solve the underlying problem of structural supply deficit meeting inelastic industrial demand. Eventually, physical reality asserts itself regardless of financial system support. The alert in the title signals urgency because these dynamics are accelerating rather than stabilizing. Each round of emergency lending suggests problems are intensifying rather than resolving. Each widening of physical paper price spreads indicates growing disconnect between financial markets and commodity reality. Each new margin requirement increase or policy intervention hints that officials are struggling to maintain control. For market participants, the implications are clear. Paper silver prices backstopped by Fed lending don't reflect true scarcity. Physical silver, in genuinely deliverable form, commands substantial premiums because actual supply is constrained. The gap between these two prices represents both the magnitude of market distortion and the potential repricing once that distortion can no longer be maintained. The Fed has confirmed through its actions that major financial institutions need emergency support to navigate current commodity market conditions. That support is blocking true price discovery by preventing forced position liquidation. But it cannot continue indefinitely without creating larger problems down the line. The secret is out for anyone paying attention. The Fed is propping up banks that bet wrong on silver. The question is how long that support can continue before physical shortage forces prices to reflect reality, regardless of financial system implications.